Anton, thanks for joining us today.
Pleasure.
So what do you see as the biggest risks for an Australian equities portfolio in the next 12 months?
Look, the market's had a big run. Obviously, it's at 5-year highs. The Dow Jones is at an all-time high. The Nasdaq looks a bit frothy. So, look, valuations look fairly not that cheap anymore. A lot of stocks look quite full. Interest rates are at record lows. They can't go much lower. So there are risks. And I mean, at the end of the day, all the volatility we had in the market only not that long ago, a year or two ago, about the concerns about the euro and Europe. Really, a lot of those things haven't gone away. It's pretty quiet at the moment. The volatility is very low. There's liquidity around, and valuations are full. So I think we will see a bit of volatility in the next 3 to 6 months. I'm not sure what's going to cause it, but it feels to me like there's a bit too much complacency in the market at the moment. So I think one's got to be cautious at the moment, but I think there will be opportunities in the next 3 to 6 months. Look, it's very difficult. I mean, there are so many imbalances in the world, I think. You've got obviously the US with zero rates and still quantitative easing. You've got China, which, looks like it is slowing, and it'll be interesting to see the reaction from the government if property does have a bit of a downturn. Obviously, Japan's experimenting with its form of quant easing. European rates, there's talk of European rates going negative. So look, it's quite a mixed scenario around the world. And I guess equity markets are in this sweet spot where, rates are low, economic activity is not bad. So it's actually not a bad environment for equities. But the point is, it's quite fully reflected in the prices now.
There's been a lot of talk with some of the brokers about this concentration risk that Australians are very exposed to banks and to resources. What's your view?
Yeah, well, again, if you look at the index in Australia, 70% of the ASX 300 is basically concentrated in 20 stocks. 50% of that of those top 20 stocks are financials. The banks, AMP, Macquarie. So, most people, I guess, feel very comfortable owning top 20 stocks. I'd imagine most self-managed super funds have got, a bank or two or three because of the franked dividends. Probably own a BHP, some Telstra, and that's probably the level of the diversification, which really isn't, a very diversified portfolio. So I guess, there is this over-concentration in our index, and because many of those stocks, such as the banks, have done well, people feel very comfortable in them. But the truth is they are all looking pretty, quite fully valued. Again, I don't see big risks for the banks in the short term. Their main source of income is their mortgage books, and Australian house prices seem to still be holding up very well, and there don't seem to be too many bad debts on the horizon. So, look, overall, the banks are fully valued. I don't think I'd be buying them up here. I think the resource shares have obviously got issues with the iron ore price now, back below 100. So look, the top 20, there's not that many. We're not finding many attractive stocks in the top 20 at the moment.
So what's the solution to that?
In terms of?
Getting outside, you obviously see the opportunity.
Yeah, I mean, there's a lot of, outside the top 20, there are a lot more sectors and different stocks and situations, and there is a bit more diversity. I think investors have got to just have a little bit more diversity in their portfolio other than the top 20. Because the top 20, investing in top 20 stocks does not give you enough diversity across sectors and across the market.
Anton, just from a quality perspective, because the Australian market, in my view, is relatively shallow, is there sufficient quality to, outside that 20 to avoid shocks within businesses, and a balance sheet's good enough outside the 20 to put together a really good portfolio? Yeah,
look, we've always had a bit of a bias towards the stocks outside the top 20. I mean, there are a lot of sectors and stocks, I could talk about Caltex, which is the #1 fuel distribution company in Australia, Orica, which is the biggest explosives company in the world, Amcor, which is one of the biggest packaging companies, in the world. They're not a bank or a resource share, but they're not going to go away either, and in terms of shocks, I mean, they're huge companies, #1 almost, well, some of them #1 in the world, like Orica's #1 in the world. Ansell, which makes gloves and condoms, it's #1 in industrial gloves in the world, #2 in condoms around the world. So there's substantial companies in their sector, you know, they're very good quality. I think they're as good quality as any of the top 20. It's just they're not as large as the top 20. But in the area of operation they're in, they're number 1 or 2 sort of either in Australia or in the world. So, you know, they're pretty well positioned. Then it comes down to a matter of price, you know, buying them at the right price.
Now. Have you had a look at the pipeline and is there anything that's
Yeah, look, we're a little bit cautious on many of the IPOs. I mean, many of them are coming out of private equity who don't tend to be sort of, you know, overly generous in providing gifts to investors. I think it's fair to say. I think, you know, private equity, they're very clever people, and what they do well is, if they're doing their job properly, is they buy as cheaply as they can off the market, and they float, you know, they sell it off to the market as expensively as they can. So I think one's got to be a little bit cautious, you know, about some of these floats. It is a vendor who's bought something a year or 2 or 3 ago and is looking to exit. So you are getting in at someone else who's quite clever. You're getting in at their exit price. So I think one's always got to be a little bit cautious, you know. And if you look at sometimes the hockey stick in earnings in some of these floats, it's I guess the best of that growth might be behind some of these things. You know, if you look at Spotless, which we owned for many years, and you know, not a bad company. Does a lot of cleaning, laundry, etc. And you know, the earnings appear to have doubled in the last couple of years. You know, under private equity ownership, so they've done well. But you are buying now at a company, a very old established company in Australia, whose earnings have, you know, been doubled in the last couple of years. So, you know, we used to own them when the earnings were half this amount, and they didn't trade very well, and private equity paid what seemed a good price 2 years ago, and here, you know, a lot of people are buying them now, and the earnings are double, and there doesn't seem to be a lot more, you know, upside in terms of cost savings, etc. So I think one's got to be cautious.
And were you surprised that it had a strong debut?
Yeah, pretty surprised, yeah. But again, it's early days, you know, shares are long-term investments, and sure, there's people very enthusiastic, there's numbers in the prospectus. I guess it'll come down to not just the delivery of 1 year's numbers, but I guess in terms of where the company is in 2 to 3 years. You see, when you take over a company, it's not that hard to sort of, you know, boost earnings. You can cut things such as, you know, a lot of discretionary spending. You can cut your advertising, you can cut your IT expenses, you can cut your marketing expenses. You know, that's all very easy to do, which helps your earnings, you know, this year and perhaps next year. But in the long term, if you don't invest in marketing, if you don't invest in IT, if you don't invest in advertising, you know, you might find that the earnings 2 or 3 years down the road may struggle a little bit. And, you know, we've seen that with things like Myer and Pacific Brands, you know, previous private equity floats. They may look good for the first 6 to 12 months as, you know, the prospectus numbers are reached. But thereafter then, you know, to keep a company's earnings going 2 to 3 years in the future, one's got to invest today. And cutting costs drastically today to make a short-term number may have an impact later on down the track. So we'll see with some of these things. I'm not saying any stock in particular, but I think one's just got to be wary of the way one can boost short-term earnings to the detriment of earnings, you know, 18 months to 2 years down the track.
Is there one that you think's got a lot of potential?
Look, before Christmas, Amcor floated off Aurora, which was its Australian packaging arm. Brambles floated off Recall, which was its document storage business. We bought shares on the market on both those companies. Subsequently, they've both gone up, 10-15% or a little bit more each. So we're not chasing them at these levels, but certainly they're companies we know. You know, they've been spun off for the right reasons. They haven't come out of a vendor. They're companies with long established track records. They're companies now that are focused very much on, you know, what they do as opposed to being part of a multinational. We've met the management, you know, very good management team, very focused now on growing their own earnings. Aurora with growing their packaging earnings in Australia as well as making add-on bolt-on acquisitions in the US. Recall with adding actually, by the way, Recall are the number 2 document storage company in the world, you know. But in some areas like Germany, whatever, they can actually make some further bolt-ons to add on to the. So we think Recall and Aurora at the right price. As I said, the market's a little bit buoyant at the moment. But I think the next 3 to 5 years, given the track record, the strength of the management, the operations, they're very resilient operations. We think those two look fairly good in the next 3 to 5 years.
Out of the existing companies that you're interested in, who do you think has got the best management team, and who have you got the most faith in?
Look, it's difficult to pinpoint one company. I mean, I think it's fair to say that the level of management of many companies in Australia is, fairly good. Again, I think the top 20 stocks tend to get a little bit over-bureaucratic, and I think the media's focus is often too much on one man when, if you look at the CBA, I think it employs 50,000 people, so it's not really about one guy. But I think when it comes to medium and smaller cap companies, there's some terrific management. I mean, I think the guys at Caltex are extremely good. Julian Segal, who pre-Caltex was at IPL and Orica. Mike Smith at Orica is doing a very good job, we think, even though the market's not giving him a lot of credence, for what he's doing. There are a lot of very good management teams. The people at Aurora, that we think are very good, and particularly, Chris Roberts, who was the chairman of Amcor for the previous sort of 15 years, and we know him well. So a lot of very good, reliable, conservative people, so it's hard to pinpoint. I think, Sonic Healthcare's been a terrific company. Colin Goldsmith and Chris Wilkes, who've run the company for 20 years, and have taken that company from what was a small regional New South Wales pathology provider to now Australia's largest pathology provider, Germany's largest private pathology provider, and the US, they're number 3 in the US. So, those sort of people have just done amazing work. And they're still there, and they're still trying to, create value for shareholders. So, and we own shares in all of those companies, and, still happy to back them, despite some of their share prices being a little bit elevated today. But, yeah.
How would you invest $1,000 today?
Look, again, today, if I had to invest it, I mean, obviously, you start off with cash, I'd be a little bit cautious. I'm a big fan of averaging into the market, I don't think you need to charge in as of today. Certainly, I think, you'd look to put, 30, 40%, 50% into Australian shares. As of today, probably 5 or 10%. I don't think there's a lot of value, but as I said, I think there will be volatility in the next 6 months. It can't just stay this calm for in my experience, this sort of complacency tends to lead to a bit of volatility. I quite like REITs, listed property trusts for superannuation funds. Again, a lot of them are trading at premiums to net tangible asset backing. Many of them will go ex-distribution in June, so they'll be a little bit weaker ex-June, so that'll be the time to buy them, end of June, July, and 10 to 15% in LPTs, 40 to 50% Australian shares, and perhaps a little bit in overseas shares. One's just got to be a bit cautious, again, given the high level, with the Dow at 16,600, the German, the DAX is at 10,000, those overseas markets look fairly fully priced as well. So I think you'd keep a fairly good proportion in cash today and try and average in, the next 6 months.
Fantastic.